I'm not hearing anything over here, Balaji. Good
Can you hear me
evening.
now?
Yeah, I'm hearing you now.
Okay, just hold on. I'm trying to fix my I don't know what happened to this earpiece. Just wait.
Okay.
Can you hear me now?
Yes.
Okay. I just needed to be sure. What of Mr. Mark? Can you hear me? Mr. Mark? Mr. Mark? Probably he's not on the call. Okay. But Eniola, you can hear me, right?
Yes, yes.
All right, no problem. So let me just I don't know why he's not on the call. Mr. Mark, are you on the call now? Mr. Mark. Okay, I don't know what's wrong, but can you see my screen?
Yes, I'm seeing your screen.
All right, so I'll be I'll be making use of the um I'll be making use of the icon pack and another material so that we can please you guys should use it so that we can have the class proper. So we are going to be talking about please hold on. I'm here for you. If one and go, you go on, you go on, look at all right. Sorry about that. Okay. Okay. No problem. Let's just continue like that. So IAS 7 cash flow statement. Cash flow statement. So now let's take it from presentation of a financial statement. Now we know that when we are presenting financial statements, according to the standard IAS 1, the standard requires that in presenting financial statements, there are 5 components of financial statements according to the standard that should be presented to make a complete set of financial statements according to the International Accounting Standard 1. And one of those 5 components is the cash flow statement, and other components such as the statement of profit or loss and other comprehensive income. We have the statement of financial position. We have the statement of changes in equity. We have the statement of cash flows, and we have the statement of accounting policies. So cash flow statement is one of the compulsory requirements. One of the compulsory requirements in accordance with the International Accounting Standard 1. Please confirm that we can hear me before I move on.
I'm hearing you. We are hearing you.
All right. So cash flow statement is one of the compulsory requirements of presenting a financial statement in accordance with IAS 1. That's the statement of cash flow. So from the material here, which is the ICAM pack, we are going to see that IAS 1 states that the statement of cash flows is a part of a complete set of the financial statement of an entity. It provides information about 1, the cash flows of the entity during the reporting period. Now, and 2, the changes in cash and cash equivalents during the period. Now, I will want to dwell on these 2 things. First of all, the cash flows of the entity reporting period. So 2 things there. The cash flow of the entity during the reporting period. The cash flow of the entity during the reporting period. The first one, the reporting period. So the reporting period is that period of what? Period of 12 months, which organizations are expected to report their performance for the period. So the cash flow is prepared, or it shows, the statement of cash flow shows how cash has been used up during this reporting period. And secondly, the cash flow statement is prepared to show the movement or the changes in what? Cash and what? Cash equivalent. The changes in cash and cash equivalent. Now, let's break this down into 2. Cash. When we talk about cash, cash here simply means cash in hand and what? Demand deposits. Cash in hand and demand deposits. We'll talk about cash. Now we're looking at 2 things, cash and cash equivalent. So we are saying that the cash flow statement shows 2 things. Number one thing that the cash flow statement does is that what? It shows the cash flow of the entity during the reporting period. And we said the reporting period is a period of what? 12 months, in which every entity is expected to what? Prepare their account towards. Now, then it shows the changes in cash and cash equivalent. So there are 2 different things here. The first one is cash. 2 different things. The first one is cash. Then another one is what? Cash equivalent. So cash equivalent, there are 2 different things. Yes, For the purpose of cash flow statement, we are going to be combining them together, cash and cash equivalent. But let us take them one after the other. When we talk about cash, cash simply means cash in hand or demand deposits. Cash in hand or demand deposits. We will now talk about cash equivalent. Now, cash equivalent simply means highly liquid they are short-term, highly liquid investments that are readily convertible to known amounts of cash. Short-term, highly liquid investments. Okay, let me just write it. Short-term, highly liquid investments. Highly liquid investments that are readily converted into what? Cash. That is cash equivalent. Short-term, highly liquid investment that are readily converted into what? Cash, and which are subjected to an insignificant risk of change in value. Which are subjected to an insignificant risk of change in what? Value. So that's cash equivalent. So cash equivalent, they are short-term, highly liquid investments that are readily converted into cash, which are subjected to an insignificant risk of change in value. So we're talking about cash and cash equivalent. Examples, we are going to be talking about cash in hand. We're going to be talking about cash at bank. We're going to be talking about bank overdrafts. And we're going to be talking about short-term investments. So these are examples of what? Cash and cash equivalent. Cash in hand, cash at bank, bank overdraft, short-term what? Investments. They are examples of cash and cash equivalents. Examples of cash and cash equivalents. So the cash flow statement reveals two things. Number one, it shows the cash flow of the entity during the reporting period. And number two, it shows the changes in cash and cash equivalent during the period. So basically, we can say that cash flow statement is used to show the inflows and outflows of cash and cash equivalent. The inflows and outflows of cash and cash equivalent. So that's basically, in summary, what a cash flow statement is about. Shows the inflows and outflows of cash and cash equivalent. Now, so let's continue. Now, a statement of cash flow provides information about where a business obtained its cash during the financial period and how it made use of its cash. The statement of cash flow provides information about where a business obtained its cash during the financial period and how it made use of its cash. How the business made use of its cash during the financial period and where the business obtained its cash during the financial period. So, for the purpose of preparing a cash flow statement, a cash flow statement is prepared by dividing the statement into three activities. The cash flow statement is prepared by dividing the statement into three activities. The cash flow statement is prepared by dividing the statements to 3 activities. Now, number 1 is operating activities. Number 2 is investing activities. And number 3 is financing activities. The operating activities, investing activities, and financing activities. So these are the 3 activities at which the statement is what's divided into: the operating, the financing, and the what? Investing. So let's take these 3 activities one after the other. We will talk about operating activities. Operating activities are those activities that arises as a result of the day-to-day operations of the business. As a result of day-to-day operations of the business. So it is from the operating activities we derive our operating profits. Our operating profits. Now, our operating profit is derived as a result of the operating activities that the business has carried out for that reporting period. So, and what are those events or those transactions that helps us to be able to determine our profits? They are such as the revenues that have been earned for the period and the expenses that have been incurred for the period. So remember that we earn the revenue, we incur expenses for the period, match them against each other to determine the operating profit. So operating activities are actually those activities that are derived as a result of day-to-day operation of the business. So under the operating activity, so look at it now. The operating activity now can now be broken down or can be calculated using 2 methods. Now, using 2 methods of operating activities. Now, the operating activities can be calculated using 2 methods, and these methods are: 1, the indirect method, and 2, the direct method. The indirect method and the direct method. So the 2 methods will definitely arrive at the same result, but the approaches are different. The 2 methods will arrive at the same result, but the approaches at which we are going to use in arriving at those results will definitely be different. But let's start with our indirect method. Indirect method first. So under the indirect method, now under the indirect method, our starting point is the profits before tax. Now, the profits before tax. So our starting point is the profits before tax. Now, where are we starting from the profit before tax? Now, understand that. Okay, I'm coming. Let me show us an income statement first. Now, let's come back here. This page 563. So, let me come back now. So, let's quickly check something. Now, let's look at the format of an income statement. Now, from the format of that income statement, I want to explain why we are starting from the profit before tax. And where is it? It's not here. I can't find it. Okay, so let's look at this now. So let's look at this now. Let me copy this here. Now, let me copy this. Come. I'm coming.
Yeah, I want to understand this. I see wondering.
Not getting what I want. Let me see if I can do this. This is business. I'm not getting what I want to do. Okay, let me just use this. Are we together? Huh? Are we together? Are we still here? Hello. Eniola, Mr. Mark. Okay. I think we can hear. So let me just move on. Okay. So let's see this now. Now, if we look at this, we see that this is our profit before tax. This is our profit before tax. Now, this profit before tax is the profit as a result of the operation of the business for that period. Is the profit as a result of the operation of the business for that period. That's a profit before tax. Now, why are we starting back from profit before tax? Remember that this is your profit before tax. Finance costs. If you look at finance costs comes. Finance cost comes before your profit before tax. So it means that to derive at this profit before tax, we have what? Deducted our finance cost, which are our interest expenses for the period. Now, there's a profit that we call profit before interest and tax. Now, that's the profit before we are taking into consideration any finance cost. So as a result of finance cost has been charged from the profit before interest and tax to help us get to profit before tax. Now, we now want to what? Remember, we want to restate that profit before tax to become a cash profit. So, taking this profit before tax, the next thing we are now going to do is what? The finance cost and all interest expenses that has been deducted before arriving at this profit before tax will be added back. It is going to be added back to the profit before tax. Then that would now give us, when we say add back finance costs. So if I add back finance costs, now why am I adding back finance costs? I'm adding back finance costs because the finance cost has already been what? Deducted from the profit before interest and tax to give me back my profit before what? Tax. So if I add back my finance cost, it means that I'm going to be getting my what? Operating profits. My operating profits. So this operating profit now, the operating profit now is the profit that I have generated as a result of the operation for the reporting period. Then, once I have derived back at my operating profits, the next thing I'm going to do is what? I will make adjustments for non-cash items. Now, why is it necessary or important to make adjustment for non-cash items? Now, it's very important to make adjustment for non-cash items because, one, in deriving at your profit, there are some expenses we have incurred that doesn't deal with movement of cash, and there are some incomes that we have generated for the period as well that does not deal with movement of cash. So, because those incomes and those expenses doesn't deal with movement of cash, now it has reduced the effect of the profits that we are going to be realizing as a result of cash profits. So it means that the profit that we have, according to your statement of profit or loss, is based on accrual. The profit we have is based on accrual. But here, in the cash flow statement, we are not interested or we are concerned about the cash. So anything that doesn't deal with cash has to be what? Not considered. So that is why we are going to make adjustment for those non-cash items. So making adjustment for those non-cash items will help us to what? Take our profit back to the original state. Will help us to bring our profit back to the original state. So one of those items that are non-cash in nature that will take consideration into is depreciation. Now, depreciation is a non-cash item, and remember that in the profit or loss statement, depreciation as an expense has been used to reduce your profits. So, because depreciation has been used to reduce our profits, what are we going to do? We are going to add back depreciation. So, adding back depreciation means that what we are going to what? Increase our profits. So depreciation is a non-cash item because when we made provision for depreciation, there was no cash movement. It was just based on a concept. The money did not go anywhere. The money remained in the business. So we have to add it back to increase our profit. Now, another non-cash item is amortization. Now, amortization is the same thing as depreciation. So depreciation is to non-current asset, while amortization is to intangible asset. That's depreciation is to non-current tangible asset, while amortization is to non-current intangible asset. So amortization is having the same effect that depreciation is having. So we are adding back amortization to boost up our profits. Another one is profits on disposal of non-current assets. Profits on disposal of non-current assets. Now, when we dispose non-current assets, if we acquire a non-current, okay, let's say the net book value of a non-current asset at the end of the period is 5,000, and we sold it for 6,000. So if you look at it, we are going to be having a gain of what? 1,000. Now this 1,000, this gain on disposal of 1,000, this gain on disposal of 1,000, it is not, it does not involve movement of cash. It doesn't involve a movement of cash. Now, the net book value as at the end of the reporting period is 5,000. So if you look at this 6,000, now this 6,000 is the sales proceed. The 6,000 is the sales proceed, and this sales proceed is a cash item. Why? Because it is the amount we are receiving when we make that sales. It's the amount we are receiving when we dispose that non-current asset. So if we are receiving 6,000, and as that when that item is being sold, it costs or it's worth 5,000 in our book. So there is 1,000 as a gain. Now the 1,000 that is a gain, it doesn't involve any movement. There is no movement in of cash in that 1,000 naira. So that's gain on disposal. Now, in your income statement, gains on disposal or profit on disposal would have been used to increase your profit before tax. You know, your income statement, profit on disposal is an income, or gains on disposal is an income. You would have added this as part of your income in order to increase your total income for the period. So as a result of that, because it is not having a cash effect, what are we going to do? We are going to what? Take it away. So we are going to deduct it. So by deducting it, it's going to take out or eliminate that effect of what? Non-cash. Then another one is loss on disposal. Loss on disposal. So if you look at the loss on disposal, that's the reverse of gains on disposal. So if, as at the end of the reporting period, my net book value is 5,000 and my sales proceed is 4,000. So that means I sold for 4,000 and my net book value is 5,000. So it means I have incurred the loss of what? 1,000. So this is a loss on disposal. A loss on disposal. So a loss on disposal is an expenses. Remember, it will always be what? Treated as an expenses in the income statement for the period. So because it is always treated as an expenses in the income statement for the period, and it would have been used to reduce, your profit, which is the profit that we are requesting for. So what we are going to do is what? We are going to add it back. Add it back. So it is going to increase or eliminate the effect of what? Non-cash. Remember, what we are dealing with is what? Adjustment for non-cash items. Adjustment for non-cash items. adjustment for non-cash items. So we have to adjust our non-cash items. So adjusting our non-cash items will now help us to be able to see our profit from the cash point of view and no longer take into consideration all those things we have added to it as a result of the accrual concept that we are using or we are basing the preparation of our profit or loss statement on. Then another item that deals with under non-cash items, okay, your investment income. Now, just as your finance cost. Now look at your finance cost or investment income. For example, now your finance cost comprises of all your interest paid for the period. So in your finance cost, all the interest expenses we have incurred for the period can be found there. Now, interest expense, according to the standard, is to be treated as either an operating expense and activity or a financing activity. Interest expense, according to the standard, is either treated as an operating activity or a financing activity. But remember that in this your finance cost, we have the composition of our interest expense already included in that finance cost. So if we have the composition of our interest expense included in the finance cost, so for us to be able to treat these interest expenses very well, we have to go and eliminate that finance cost. Then we can be able to determine our interest expense. So that is why we are adding back the finance cost. The same thing, investment income. Now, investment income is supposed to be treated as an investing activity. So in your income statement, you have your investment income. So all investment income would have what, as a one way or the other, added up to your total income for the period. So for me to be able to treat this investment income appropriately as an investing activity, I have to go and net off that investment income as a result of what has been recorded on my income statement. So my investment income has been used to increase revenue on the income statement. Then what I'm going to do is what? I will deduct it so that I can be able to what? Now treat my investment income appropriately as an investing activity. So then after that, after all the non-cash item has been considered, then we have cash flow from operating activity before changes in working capital. Cash flow from operating activity before changes in working capital. Which will be, should give us this. Then we have changes in working capital structure. Changes in working capital structure. Now, before I continue, please let's confirm that we can hear me. Please let's confirm that we can hear me. I don't just want to be guessing that we can hear. Eniola, can you hear me? Eniola, oh. Uh,
My
okay.
battery is
Ama,
low. I'm here. My battery is low. That's why I'm here.
but hope you can still. Are you going to find the means to charge?
Yes, I'll try.
Okay, no
Driving.
problem. Yeah, but everything I've explained so far, are you getting it?
Yes, yes, I'm understanding.
All right, no problem. So let's continue. Now, the next thing, like I said, is the changes in working capital structure. Now, the question is, why do we have to bring in changes in working capital structure? First, what is working capital? Working capital, from an accounting point of view, is the money you have, right, to run the day-to-day administration of the business. That's working capital. So remember, we said our working capital is equal to what? Current assets minus what? Current liabilities. That's our working capital. So the money we have left to run the day-to-day activities of the business, that's working capital. After we have financed the business, after we have made investment decisions, we need money left. We can't invest everything we have. So as we are sourcing out for finances to um, finance the business with, we need to think about investment as well. And at the same time, we need to think about, if we invest on a long-term asset, what will be left to run the affairs of the business on daily basis. So working capital simply means what we have that is used to run the business on a day-to-day basis. Now, one way or the other, working capital would have had effect on your operation for the period. One way or the other, working capital would have had effect on your operation. So, because working capital would have had effect in your operation for the period, now we have to now look into what are the effects it would have what had. So, remember, we say working capital is current asset minus what? Current liability. And what are your current assets? Example is your inventory, your trade receivable, your trade receivable, your prepaid expenses or your prepayments. Let's say prepayment. Then the current liabilities, we have trade payable and we have what? Accruals. Trade payable and what? Accruals. Coming, trade payable and accruals. So, I'm coming, sorry. And these are your current assets. Exactly. Now, I said, one way or the other, your current asset and your current liabilities or your working capital would have had effects on your operation for the period. So the effect it's going to have on your operation for the period is that what? When we have inventories, there's possibility that we have inventory as at the beginning of the period. We have inventory amounting to 6,000 naira. That's as at the beginning. Let me say 31st December 2009. Then as at 31st December 2010, I have inventory amounting to 8,000 naira. Now, trade receivable as at 31st December 2009, I have trade receivable amounting to 12,000 naira, and I have trade receivable as at 31st December 2010 amounting to 10,000 naira. Now, repayment. Repayment are payments that have been made or received in what? Advance. So repayment. Now, Okay, let's just deal with inventory and trade receivable. So if we look at your inventory, now remember that as at 31st of December 2009, my inventory is 6,000. Now, as at 31st of December 2010, my inventory is 8,000. What does it mean? It means that what? It means that inventory in 2010 is higher than inventory in 2009. So I sold inventory, or I have inventory of 6,000 rather, right? And I have inventory of 8,000. It means I have bought more inventory into the business. And remember, your inventory are more like your frozen stocks that you have left as at the end of the period. So I have bought more goods. So in this case, my inventory has what? Increased. I have bought more goods. I have 6,000 as at 31st of December 2011, and I have 8,000 as at 31st of December 2010. So the effect is that what my inventory has increased. So when my inventory increased, it simply means that I have bought more goods, and automatically there's an outflow of cash. It means cash has gone out. So we're looking at the cash effects now. That's why we're looking at the changes in working capital structure. So changes in working capital structure will help us to know the effect, the cash effect that has happened. So an increase in inventory from 2009 to 2010 simply means what cash has gone out. So our changes in working capital will come here. Increase in inventory. Now, increase in inventory, that will be and what? Outflow. Increase in inventory, that will be an outflow. Now, let's look at the next one, trade receivable. So, the trade receivable as at 2009 is 12,000, and as at 2010 is 10,000. What has happened to our trade receivable? It has what? Decreased. There is decrease in trade receivable. So if I have trade receivable in 2009 to be 12,000, and I have trade receivable in 2010 to be 10,000, it means that what I have received cash. I have received cash. So a decrease in trade receivable shows an inflow. Now, so look at it. Decrease in trade receivable will show an inflow. Now here's the logic. So the logic is generally, let me just put it under here. Increase in assets will be an outflow, while a decrease in assets will be an inflow. So that's the logic. So in a question, it can be trade receivable that is increasing while inventory is decreasing. They are both assets. So anytime an asset, that's the current asset now, which forms part of the working capital, anytime an asset is increasing, is an outflow. That means money is going out. And anytime an asset is decreasing, is an inflow. Money is what? Coming in. Now, reverse is the case when it comes to current liability. So in current liability, now in current assets, if an asset is increasing, is an outflow. Then for a current liability, if the current liability, for example, trade payable, is increasing, that is an inflow. You look at it, 20,000 in 29 and 25,000 in 2010. That's an increase. So now my trade payable in 29 is 20,000, and my trade payable in 2010 is 25,000. That's an increase. It means that my trade payable has increased this year from what it was in last year. That simply means what? Money has what? Coming. So that's an inflow. That's an what? Inflow. It means we have bought more good. So money has come in rather. So that's an inflow. So if I come to this place, increase in trade payable. So increase in trade payable. That's what? An inflow. Then decrease in, let's say, trade payable. That's an what? Outflow. That's an outflow. Then at the end of the day, we now have, so look at it. Remember, I said that I talked about interest expenses and I talked about investment income. So I said interest expenses can be treated as either an operating activity or a financing activity. But most times, if we go through the facts in their solution, you would always see interest expenses treated as operating activity, so that we can be guided. We have to treat it as operating activity. So now there is it. After I have considered my changes in working capital structure, the next thing I'm now going to recognize is what? Interest paid. So my interest paid, that will now be, remember, is an outflow. Interest paid is an outflow. Interest paid is an outflow. Then after that, tax paid, because of tax too is as a result of the profits you have generated for the period. So your tax paid is an outflow. Then once we are done with that, to now be net cash flows generated from or used in operating activities. So this will give me, it can either be inflow, outflow, depending on whatever we are getting. So that's operating activity. Now remember that I said that in preparing a cash flow statement, there are three activities that we are putting into or taking into consideration. Number one is operating activities, number two is the investing activities, and number three is the financing activities. So we said operating activities has their activities that are realized as a result of the operation for the period, the date of operation for the period. I now said that what these operating activities can be derived using two methods, the direct method and the indirect method. So what we looked at now is the indirect method of determining what operating activities. The indirect method of determining operating activities. Now, I want to bring a question here now. Coming. A question here now. Coming, I'm coming. Coming. Let me try to look for a question so that we can put that this thing into effect. I'm coming. I came across a question just for operating activities alone. Let's solve it. Let's just look at it. Okay, I've seen the question. The problem is okay. Now, this is what I'm going to do. Now, so let's look at this particular example now. Now, this particular example, if we can we screenshot it? If we can screenshot it so that we quickly look at it. Let's quickly look at it if we can screenshot it.
See any message from right? Broadcast.
Have we been able to screenshot?
Yes, we've screenshotted. I have screenshotted.
Okay. So let's quickly use that question now. Mr. Mark, what about so now we'll use that question, we'll solve that question just for the operating activity alone. So we'll see how everything we have done or we have been explaining can put it into okay. Daniela has screenshotted. I think Mr. Mark has screenshotted as well. So let me go back to the sheets where we are using to solve now. All right, so let's solve now. Let me come to a new sheet here now. So the following information has been extracted from the financial statement of company for the year ended 31st December 20X9. Now, requirement: present the cash flow from operating activities as they will be presented in the statement of cash flow using the direct method and indirect method. So now let me come here. Statements of cash flows for the period ended. Now the period ending is 31st December 20X9. 31st December 20X9. So we want to use, so we start with the indirect method now. Indirect method. So let me come here. A currency sign. Indirect method is naira that is there. Now, so remember that from this format, we said the first thing in your indirect method is your what? Profit before tax. And let me rename this illustration 1. Now, so what's our profit before tax? Profit before tax. Profit before tax is what? So in the question, oh yeah. So let's respond now. In the question, what's our profit before tax? Respond. Well, let's unmute to respond together so that I will know we are following in the question. Okay, so profit before tax is 190,000. Our profit before tax is 190,000. It's 190,000. No. Then adjustments for non-cash items after that. So, like I said, the first thing is that what we are going to take into consideration what take into consideration our, first of all, our what? Finance costs. Now, the question, our finance cost is what? The question, our finance cost, that's interest charge, is what? 50,000. Now, remember that your finance cost, it has been deducted before arriving at your profit before tax. So we are going to what? Add it back. Now, okay, let me put another naira sign here. Another naira sign here. So let's bring this to this place. So now, then the next thing after your finance cost, every other non-cash item, like we have rightly stated here, remember we have depreciation, amortization, profit on disposal, loss on disposal, investment income. So let's see, do we have any investment income in the question? We don't have investment income in the question, but in the question we have, they said other operating expenses, including depreciation. So depreciation was included in other operating expenses. So it means that we have to what? Recognize the effects of depreciation. Now, depreciation is how much? 25,000. So depreciation is 25,000. I remember back depreciation because it has been what? Deducted. We have to add back depreciation because it has been what? Deducted. Now, okay, so the next thing is going to be what? Now, the next thing is going to be what? So we now after that we don't have a profit on disposal, we don't have loss on disposal, we don't have amortization and any other thing. So it means the next thing we are going to be having will be what? Changes in working capital structure. Changes in working capital structure. Now, for our changes in working capital structure, so the first thing we have now, if you look at it, we have trade receivable. So let's compare trade receivable of. So we have January 1st, 20x9. We have 31st December 20x9. So if we have January 1st, 20x9, 233,000. 31st December 20x9, 219,000. So it means that what? Receivable as what? Receivable as what? Reduced. So a decrease in what? Trade receivable, which represents and what? Inflow. So decrease in trade receivable. Decrease in trade receivable. That's what? 233,000 minus 219,000. 233,000 minus 219,000. So that will give us what? 14,000, and that's an what? Inflow. 233,000 minus 219,000. That will give us an inflow. Now, the next one is what? Inventory. So if you look at inventory in inventory as at 1st of January is 118,000. Inventory as at 31st of December is 124,000. So if you look at our inventory has increased in 31st of January from what it was as at 1st of what? January. So it means that what? We have bought more goods. We have bought more goods, which has resulted to an outflow of what? Cash. So that's increase in what? Inventory. Now, increase in inventory. So that will be what? 124,000 minus what? 118,000. Now, that would give us what? 6,000. That will give us 6,000. Now, the next thing is trade payable. Trade payable. So if you look at our trade payable in 1st of January is 102,000, and trade payable as at 31st of December is 125,000. That's an increase in what? Trade payable. Hey, sorry, I said increase in this thing is supposed to be an outflow. Now, increase in trade payable. So increase in trade payable, that will be what? 125,000 minus what? 102,000. So that would be an what? Inflow of what? 23,000. So remember we said that what? When an asset is increasing, is an outflow. But when a liability is what? Increasing, is an inflow. Then the next one is, now if we look at the next one, we see accrued wages and salaries. Now that accrued wages and salaries will be relevant when we are computing operating activity using the direct method. When we are computing operating activities using the direct method. Now, the next one is accrued interest charges. Now, so before we go to this next one, which is interest paid, and the next one will be what? Tax paid. Now, we have to do some workings there. We have to do some workings. We have to do some workings. So workings. Now, workings 1 will be for interest payable. Now, if we look at our interest payable, we will see that now these workings I'm not going to use a T format for it. I'll just use the normal addition and subtraction. So this accrued interest charge. Now, let me quickly chip in something. Remember that I said that your finance cost is made up of your interest expenses. So anytime you are giving finance cost in your profit or loss statement, you have to check your information very well to make sure that there is no further information that is talking about accrued interest. Now, if there is no further information that is talking about accrued interest, so it simply means that your finance cost will represent your interest expense. That's your interest paid. But anytime there is an additional information that is talking about accrued interest, that is interest that is payable as at the end of the period. Now we have to make adjustments for it to be able to reflect or show how much interest exactly was what paid. So let's look at it. As at the beginning, I'll come here. Balance brought forward. As at the beginning, my interest, my accrued. Now, this, assuming I don't have these accrued interest charges in the question, my interest paid here would have just been my finance cost, which is 50,000. I just bring it there, 50,000. But because of these accrued interest charges, so it means that what, as at the end of the year, I am still owing interest. I have not paid all my interest. So I want to know how much exactly was the interest I have what paid. I have recognized 50,000 as my interest expense for the period on my profit or loss. And at the end of the day, they are telling me that what I still have an amount of interest I am yet to pay. So I want to know how much is the interest I have paid. So my balance brought forward, that is the opening balance, will be what? 30,000. Now, I'll come here. Balance carried down. That's the closing balance. How much is the closing balance? 45,000. So now, remember that in your profit or loss, how much is my interest charge? So interest expenses, POL. POL. How much is my interest expenses? POL 50,000. So I want to know how much is my interest that I pay. So if I sum this together, what will it give me? 80,000, right? So the total of 30,000 and 50,000 will give me 80,000. So it means that my interest paid will be what? So look at it. This 80,000 minus what is that will give me what? 35,000. So this represents my what? Interest paid. So I just put it in red so that we can see. So this represents my interest paid. So it is this my interest paid I will now bring here. So I will say workings 1. So it's my interest paid I will bring here. So how much will be my interest paid? 35,000. So you can see what we did now. So this is your closing balance. So instead of T format, or in the absence of T format, we can use this for our adjustments. This is even more simpler, more straightforward. They would always accept this one because going through the past questions, this is what they majorly use for their adjustments. So instead of T formats, we can use this. So we can see that this has helped me to be able to determine how much interest was paid. So in my profit or loss, the total interest I am incurring for the period is 50,000 naira. But as at the beginning of the year, I'm owing 30,000 naira interest. And as at the end of the year, I'm owing 45,000 naira interest. So if I'm owing 30,000 at the beginning and I'm owing 45,000 at the end, and what I recognize in my POL is 50,000, then how much exactly did I pay? I pay what? 35,000. Now, working note 2, tax paid, or let me just say taxation. Now, I want to recognize taxation. So the same thing we have done here. Balance brought forward. Now, my balance brought forward. My balance brought forward. Now, for tax. So tax payable. So as at the beginning of the period, my balance brought forward is 52,000. Now, balance carried down. Now, my closing balance is 43,000. So, in my income statement, my income tax expense, let me just put it there, POL. My income tax expense, POL, is how much? How much is the income tax expense? 40,000. So at the end of the day, if I sum this plus this, that will give me what? 92,000. So then my tax paid will now be what? This guy minus what? This guy. That's what? 49,000. So it means my tax paid is what? 49,000. So tax paid. So I'll come here. Workings 2. So workings 2. How much is my tax paid? 49,000. Then at the end of the day, let's sum up this. Okay. So at the end of the day, let's sum up this. This will give me no. This is my house this plus this. So this will give me 100 and what? 18,000. 118,000. Please let's confirm. 50,000 plus 25,000 plus 14 minus 6. Oh, that's 106,000. Why is it giving me 118? Let me recalculate again. 50,000 plus 25,000 plus 14,000 minus 6,000 plus 23,000. Come. 50,000 plus 25 plus 14 plus 23 minus this. Am I getting 106,000? Coming 50 plus this plus this plus this plus this. Okay, that's 106,000. That's correct. Then, so this guy, let's move it to this side. This guy, let's move it to this side. So yeah. So this guy is and this guy too represents. Then at the end of the day, let's sum it up. This plus this plus this plus this, that will give me. So I'll say net cash flows generated from operating activities. So net cash flow generated from operating activities. So my net cash flow generated from operating activities is going to be what? 212,000. So this is an example of how to calculate for your operating activities using indirect method. So using indirect method. So this is an example of how to calculate for your operating activity using indirect method. Using indirect method. Now, because we started late, because I was trying to fix some one or two things. Now, next time we are going to start much more earlier, so that we are going to be able to cover up a complete question. So, but based on indirect method, this is how to calculate operating activity using indirect method. So, any question? Is there anything that I did in the illustration that we are confused, that we need more clarity on? Any question? Yeah, any question? Okay, so I guess in the absence of no question, let's stop here for today. So what I'm going to do is I would share a question for us, and that question I'm going to share, we are only going to use that question to calculate only operating activity using indirect method based on what we have done. Only operating activity using indirect method based on what we have done. Only operating activity using indirect method. So when we now meet again, we'll now go into how to calculate investing activities and financing activities. Then from there, we would now look at a past question, look at a more comprehensive question, and solve everything all together. Any question? Okay, so any question?
I don't have any question. No.
Is it clear?
Understood everything. Yes.
All right. So we have to stop here now because of my data is already telling me this
Okay.
thing. So
Thank you very
next
much.
we are
I
going to
really
be meeting
appreciate.
on Wednesday. So meet on Wednesday.
Okay. No.
But Wednesday we are going to be doing PM on Wednesday. We are having PM on Wednesday. So I think we'll just be doing this and like that as we prepare for the exams. So we are going to be having PM on Wednesday, and that will be what topic again? Okay, we're starting with activity-based costing. Activity-based costing. Activity-based costing on Wednesday. Then all right now. So let's
Yeah,
have a
all right. Thank you.
wonderful. Bye-bye.
Yeah.
The math was not. I don't have it's not. Serious. Not really mistake. We can go.